Potomac Wealth Advisors founder and president, Mark Avallone. Mark, great to see you. Thanks so much for being here. So 100 billion here, 200 billion there, $1 trillion there. This is a lot of money as we're adding it up. Are we going to see a return on investment in all this?
Well, at some point, you have, as an investor, you have to trust in the management of these companies. And you have to trust that they are the leaders. They're today's Carnegies and Rockefellers. And this is the new roadmap for America. So investors thus far have taken a lot of confidence in the fact that Microsoft and NVIDIA and Alphabet are visionaries, and they will produce. And thus far, they have. The reason they have so much cash on their balance sheets that can make these investments is that they have been very, very successful. And you don't want to throw out a few billion or 10 billion or so like Meta did a few years ago when they went down their path. They quickly corrected. So I think that these investments for now are prudent. They're necessary for where we're going. And I think management is prudent enough to redirect, just like Zuckerberg did 2 years ago.
In the 90s, what we saw really is a handful of companies do really well. I mean, remember when Google went public, what was it, $75? Look where Google is today. And Alphabet, right? I mean, Amazon, same thing. There were a couple of really, really behemoths, but then there were a lot of companies on the cutting room floor. Is that what we're going to see? I mean, how do we know who makes it and who doesn't out of this boom?
Well, I think the structure and the setup is very different. Going into the tech crash, we didn't have mega cap, Microsoft, Alphabet. These companies, they're bigger. NVIDIA is bigger than some of the market cap of European developed countries. So these are far from spec tech. I think if you're an investor and your reliable portfolio has cash flowing technology, then you're going to avoid the crash to a zero outcome, which you had in March of 2000. So I think investors can allocate to a small, high-risk spec tech allocation and expect that either to have perhaps great returns, but also some tragic loss. But really, if you're maintaining a disciplined portfolio of these great names that we're bouncing around, I don't think there's any correlation to what happened in the tech crash in March of 2000.
We're also looking at retail this morning because that's giving us a window into the consumer, right? Lowe's surging this morning. It's up better than 5% right now. It reported mixed earnings just moments ago. Third quarter revenue at around $21 billion. Target is coming out later this hour, and TGX will have those numbers. Walmart is the one we're all waiting for. That's coming out tomorrow before the bell. We'll have those numbers. What's your take on the consumer right now? Lowe's right now up 4.8%. Are you watching for the consumer and how that fits into this overall growth puzzle?
Well, those numbers by Target are very surprising. There are some factors here that we thought had headwinds for them.
You mean Lowe's? Target's coming out momentarily.
Yes, sorry. We were expecting a slowdown in the housing market to be a headwind. I was expecting the slowdown in our population growth to be hurting retail across the board, and that doesn't seem to be happening. The way you grow an economy is increased productivity and increased population growth. And without those two dynamics, you risk a sluggish European-style economy. And we are showing that we are resilient, and these retailers and the strength of the consumer are overcoming that. We do think that strong wage growth continues. That's another driver for these industries. Wage growth has been stubbornly high. Maybe the Fed doesn't like that, but American consumers like that, retailers like that, and the unemployment picture has remained favorable. We don't know what the September jobs number looks like, but heretofore in the low 4% with strong wage growth, that does continue to set up for a strong economic recovery, which benefits retailers across the board.
Would you buy stocks here going into 2026?
I like the pullback that just happened. I do. I think that took some of the froth out. The low-quality tech stuff's down 15 to 20% if you look at some of those aggressive ETFs.
Yeah.
If you have an allocation appetite for risk tech, it's a lot cheaper than it was just a month ago. But I think the quality names we started to show off with and big tech will continue to dominate into the future.
All right, Mark, great to get your take on all this. Thank you.
Okay.